You get a deal as an investor compared to what I can get in terms of buying the whole business, and people would be much better off than $15,000 if they just thought of stocks as pieces of business. Warren Buffett says you can buy small pieces of businesses for less than you can buy whole pieces of businesses for the premium you'd have to pay if you were buying the whole business. May not seem like much, but when invested wisely, it may produce a consistent flow of dividend income. Drawing on Warren Buffett's theory of investing, we'll examine how even a small sum can increase over time and examine 3 distinct investment scenarios. We'll look at an S&P 500 ETF, a dependable dividend stock, and a high-yield covered call ETF to see how much dividend income $15,000 may generate. By the conclusion, you'll know which investment might be the best fit for your financial goal. Let's investigate the specifics. Let's begin with a basic strategy for investing in S&P 500 ETFs. This approach is well liked since it provides wide market exposure and is manageable. We'll use this SPY ETF as an example. Following S&P 500 index guidelines, which consists of 500 of the biggest American firms, SPY now offers a dividend yield of roughly 1.55%. We will perform some basic math to determine the potential revenue generated by this. The annual dividend income, calculated as follows. $15,000 invested at a 1.55% return would generate $232.50 annually, or around $19.38 each month. This is not a substantial amount of money. But remember, this is just the beginning. The growth and reinvestment of dividends is where an S&P 500 ETF's true strength lies. If we reinvest our dividends, we buy more shares that in turn pay more dividends, creating a compounding effect. Over the preceding 5 years, the S&P 500 has demonstrated proven to have a great track record of growing dividends. The average annual dividend growth rate has been about 5.35%. This means the amount paid in dividends typically increases each year. Let's project how our $15,000 investment grows over time to demonstrate this. We'll assume the same 1.55% yield and a 5.35% annual dividend growth rate. We'll also reinvest dividends so our income can increase significantly over time. In the first year, you would earn a $232.50 dividend. Over the next 5 years, this amount would grow to approximately $285 due to the combination of dividend growth and reinvestment. After 10 years, the annual dividend income could be around $370. Compounding works even better over a longer period of time. After 20 or 30 years, the dividends could grow significantly, although the initial $19.38 per month doesn't seem all that impressive. To increase in value over time, providing capital gains in addition to dividend income. Johnson & Johnson is a strong choice for long-term investors because of its growing dividends and potential for capital appreciation. For our third scenario, let's look at a high-yield covered call ETF, specifically JEPI or JP Morgan Equity Premium Income ETF. This type of ETF is designed to generate higher income by writing covered calls, which involves selling call options on the underlying stocks it holds. This strategy can produce significant dividend income, making it attractive for investors seeking immediate cash flow. In summary, while the initial dividend income from Johnson & Johnson is higher than that from an S&P 500 ETF, the real advantage lies in its consistent dividend growth and the stability of the company. ETFs like JEPI may not have consistent dividend growth. In fact, the dividend payouts may vary annually depending on market conditions and the performance of the underlying stocks. Nevertheless, the income from JEPI could remain relatively high, but could not profit from compounding as much as conventional dividend growth companies. While JEPI offers significant immediate income, it may not offer the same long-term growth potential as the other investments. This makes it suitable for investors who prioritize current income over future growth. Over a 5-year period, your annual dividend income might still hover around the initial $1,494 mark or slightly less if dividends decrease. It's also important to remember that GEPI's price might not increase much, meaning the overall return may be mostly attributed to the high dividend yield in general. High yield covered call ETFs, like the JEPI, are great for producing quick cash flow, but they also carry a risk of less steady dividend growth and restricted capital appreciation, which makes them an excellent option for people looking for. After examining 3 distinct situations, let's evaluate their long-term outcomes. High current income, but not always favorable for individuals seeking big long-term development. Every investing strategy has specific advantages and possible disadvantages of its own. Starting with the S&P 500 ETF, which had a modest initial yield of 1.55%. The fund's strength is found in its consistent dividend growth and overall value appreciation over a 20-year period. Assuming an average annual growth rate of 8% and dividend reinvestment, your $15,000 investment could grow to about $70,000 after 30 years, and it could be worth roughly $161,000 overall. Over time, the force of compounding greatly increases the value of your investment overall as well as your income. Johnson & Johnson provided a higher beginning yield of 2.8% with these assumptions, a steady 6% annual dividend growth rate, and an average 5% annual growth rate. A sound option for individuals looking for security and a steady income rise. Your $15,000 investment might increase to roughly $50,000 over 20 years and approximately $128,000 after 30 years. This combination gives a consistent and growing income stream. Makes them a good hedge against inflation. Fourth, pay attention to taxes and fees. In conclusion, stay informed, review your portfolio on a regular basis, keep track of your investments, and make adjustments based on performance and evolving financial goals. High fees can erode your returns, so choose low-cost ETFs and tax-efficient accounts like IRAs for holding your dividend-paying investments. Maintaining a proactive approach guarantees that your plan stays in line with your goals. Before we finish, I have a few questions for you. Please let me know in the comments below which of these investment methods best fits your financial objectives and how you intend to use your dividend income to meet them. In conclusion, understanding how much dividend income can be generated from an investment of $15,000, as exemplified by the investment strategies of Warren Buffett, highlights the incredible potential of smart long-term investing. Buffett's focus on high-quality, dividend-paying stocks demonstrates the power of patience, thorough research, and a disciplined approach to building wealth. By selecting companies with strong financials and a history of consistent dividend payments, investors can create a reliable stream of income that can grow over time through reinvestment and compounding. Please give this video a thumbs up if you thought it was insightful and useful. Sharing this video with your friends and family can help them understand the benefits of dividend investing and encourage them to take charge of their financial future. Don't forget to subscribe to Investing Tutorial for more in-depth analyses, practical investing tips, and guidance on building a robust investment portfolio. Your support helps us bring you more quality content to empower your financial journey. Thank you for watching, and remember, smart investing today can lead to financial security tomorrow. Stay tuned for more videos that will help you make informed investment decisions and navigate the world of finance with confidence. Happy investing!